Hi, good afternoon. Thanks for joining our call today. This is Brian McGann. I'm the head of investment strategy here at Beacon Trust. We thought it would be a great idea so that clients could hear our voices. We've sent out 3 communications, January 29th, February 27th, and again last night regarding the coronavirus. In last night's piece, we included the new energy-related event from this past weekend between Saudi Arabia and Russia, which caused a sharp decline in global oil yesterday. As everybody knows, the financial markets have reacted quite strongly to the uncertainty surrounding the economic impact with the global spread of the coronavirus. Joining me today is Susan Hayes, our head of fixed income, and our chief investment officer, Dr. John Longo. Susan's going to open up with some comments around the sharp moves in fixed income markets. As you've all seen, the benchmark 10-year Treasury bonds hit all-time lows. It's now at about 62 or 3 basis points. Yesterday was down below 50. And then John's going to give a quick look at the financial markets and touch on the economy. But before I turn it over to Susan, from a portfolio perspective, we're not inclined to make wholesale changes across the board in client portfolios at this point. I'd encourage the open dialogue with your team here at Beacon to make incremental adjustments if you need, rather than for us to be making wholesale changes. As history has dictated, as we pointed out in our first piece, this too shall pass, and it's really impossible to market time your asset allocation. One of the most important things we focus on here with the clients is asset allocation, cash needs, cash requirements, and so forth. So again, any incremental changes to that, we're always happy to talk about and make on your behalf, but to make wholesale changes in strategy across the board in what we would view as a relatively short-term event would not suit us very well. So with that, I'm going to turn the call over to Susan Hayes for fixed income.
Thanks, Brian. I thought it would be helpful to recap just where we are in context of the unprecedented moves down in U.S. Treasury yields over the past few weeks. As Brian noticed, we've had some pretty dramatic moves down. We've moved through, previously all-time lows and basically the entire part of the curve. So the phenomenon of lower U.S. Treasury rates has actually been happening, albeit at a much slower pace, for the better part of 18 months. The steady decline in rates is due to a combination of lack of inflation, large foreign demand, and also last year you had the Federal Reserve cut rates in order to keep the economy going and keep that economic momentum. So all of those things were partial drivers of an already declining yield environment in U.S. Treasuries. And then obviously, within the last few weeks, there's unprecedented drops in yield levels to levels we've never seen before, based at first on coronavirus. And then over the weekend into yesterday, the oil price war and the steep equity declines that we saw. So, also last week, everybody was waiting and watching, hoping the Fed would act. The Fed did act. They made an emergency cut of 50 basis points, which now sees the bound of Fed funds rate at around 1 to 1.25. I feel like the market was expecting this to happen. They wanted it to happen. And when it finally happened, it was kind of like, okay, that happened. So where do we go from here? If you look out, and it seems like a very far away, time period from now, the next Fed meeting is next Wednesday, the 18th. They will have a decision. The probability right now for 2 or 3 rate cuts is almost 100%. So if they cut 3 times, then we're going to be in the position where Fed funds rate is going to be at the zero bound. So ultimately, the Federal Reserve doesn't have a lot of room to maneuver here. I expect that we're going to see them probably move to zero bound, if not at this meeting coming up in March, probably if things continue the way they are, very soon thereafter. So then what happens? Because the Fed only has, limited ammunition in terms of rate cuts. I expect that they'll probably become much more creative and adapt to changing times. They could do things like different kinds of QE. So that remains to be seen. They may give some messaging to that into their meeting next week, but that's something that we're waiting and watching. So what's happening now, and what are we doing to protect client portfolios during this period of volatility in the markets? So over the past few turbulent weeks, high-quality fixed income, like what we own in client portfolios at Beacon Trust, has performed very well and acted as a ballast to the overall portfolio. So last year, we actually began going up in credit quality. I know we've had many conversations with you about the preservation of principal quality to our portfolios and how we always keep a high credit quality mandate. So this preservation of principal mindset when investing in the portfolios has been very beneficial recently. It's interesting, though, if you look at fixed income, not all of fixed income has performed well in the past few weeks. As I said, the very high quality bonds performed very well. There were havens. People around the world were coming in to buy U.S. Treasuries, high quality munis. But you're starting to see a big dichotomy between the lower rated bonds and the higher rated bonds in the marketplace. So junk rated or high yield bonds, especially anything tied to energy, has been hit very hard. It's important to note that we don't own junk bonds in our portfolios. We're investment grade only. So this is an area of the market that saw a very steep decline in prices very quickly. Some corporate bonds have also been negatively affected as they tend to trade more in line with equities. But generally, the kinds of bonds that we own, which are larger companies, very solvent companies, have moved a little bit, but not to the degree that your junk type companies have. So in this market, it's really important to know what you own and have a level of transparency so that you know the revenue stream of the bond is easily identifiable and that you're going to get your principal and interest back at the end of the day. So at Beacon, we're continuously monitoring the credits in the portfolios and we'll make changes as warranted. So just as a reminder, I know we talk about this all the time when we're in client meetings and when we're with you face-to-face or on the phone, but in our portfolios, in the taxable or the corporate bond portfolios right now, we own a mix of FDIC-insured CDs, U.S. Treasury bills or notes, and investment-grade corporate bonds. So the corporate bond portfolios are not only corporate bonds, which decreases the level of exposure and acts as more of a ballast in when times are turbulent. In the municipal portfolios, we own straightforward credits like essential revenue and general obligation bonds in areas that are demographically desirable and have strong revenue streams or tax bases. So at this point in the market cycle and where we are now with what's happening, the fixed income in the portfolios is providing the stability that we designed it to have during turbulent times, and we expect it to continue to do so throughout this period of time. And with that, I'll turn it back to John or to Brian.
Thank you, Susan. So thanks everybody for joining us. First, I have a small number of slides to go over. We're certainly interested in your questions and feedback. Let me just kind of frame where we are today. Clearly, we're not naive in what's happening. We do believe that the virus will spread. We do believe that economic data will get worse for the next 2 or 3 months. But at this point, we're not in the camp that we're in an imminent recession that's going to last 1+ year. That latter worst case scenario would potentially result in a greater change to our asset allocation. At this point, like Brian said at the top of the call, we potentially would support a modest reduction in your equity exposure, but we don't want to sell everything, especially if you're in a taxable account. So let me just kind of frame where we are a little bit, just to give us some greater perspective here. Here's our usual disclaimer, of course. This is a website that if you've listened to some of our prior webcasts, I like to show. It's called finviz.com. It's called Financial Visualization. And the popular name for this is a thermographic or heat map. As you can guess, red means the stock is down and green means it's up. This is a screen capture of yesterday's market movement, a drop of between 7 and 8% for most equity indexes. And that was the worst drop since the financial crisis. So clearly, I think there's some panic in the air. You could look at various indicators like VIX that show a similar amount. In case you're wondering what was up, the dollar stores, and not yesterday, but during the week, gold was up. What's worthwhile to note here is that even the very high quality firms like Apple and Microsoft with $100+ billion in cash went down sharply. And as Brian mentioned at the top of the call, the energy sector was hit the hardest with the plunge in energy prices. And for example, a well-known name like Occidental Petroleum got hit 50%. So we do think there's some overreaction here. This may create some opportunities, but clearly there is a lot of fear in the market. You might be wondering what happens whenever there's a huge drop. And here we're defining huge as a 5% or more drop. Of course, the most infamous or famous example is a crash of '87 where stocks dropped 22% in one day. The good news is that usually stock prices bounce back. Part of the reason is behavioral, that whenever there's a plunge, that could mean capitulation, fear, getting a fever pitch. And you can look over here, but usually Monday has the kind of biggest drop. The crash of '87 obviously is the main example. But whenever you have a large drop, usually the market rebounds, typically a couple of percent or more on average. And it's just a relatively optimistic reason. Hopefully you're able to see our picture. We just got a comment.
What page are you on? We're on page 2.
Page 2. So I'm showing the chart for those kind of viewing remotely, what happens after a 5% drop in stock prices. As I was saying, the good news is that usually there's some rebound. And this is really true of all drops, that over long periods of time, which sometimes can extend up to 10 years, the market rebounds because you're basically betting on growth in America. So this is another reason why if you do want to make some changes for your advisor, we recommend doing it in staging or dollar cost averaging increments. Here's just a picture on slide 3 of what we call the cycle of market emotions. If we turn back the clock a little less than a month ago, stocks were at an all-time high, right? That's amazing, an all-time high since we've had stock data in America since the 1800s. But yet you can think about the despondency that we saw yesterday. And, you know, we all go through these emotions. You can't really be completely divorced from them, but what we're trying to do is get you to make rational and staged decisions as opposed to making rash decisions and panicking, because nobody knows when the top or bottom is, but generally doing in stages makes the most sense. This is a slide slide 4, that we tend to show in most of our client meetings when we do show you some material. Every single year there's a drawdown, right? The question is, how severe is it? And on average, the market drops about 14% top to bottom within a calendar year. Yet more than 70% of the time, it winds up in positive territory. Now, we don't know for sure if that's going to happen this year, but we do know that volatility is par for the course. And if you read some of our writings, I know we've been doing a lot of writing over the past year to date, but one of our forecasts this year is that volatility is going to pick up. Now, we didn't really expect coronavirus or anything like this, but why we came up with that prediction is that volatility last year was abnormally low. The biggest drop top to bottom was 7%. S&P went up roughly 30%. So the great performance we had and minimal volatility, we're giving some of that back certainly this year. So just because there's volatility doesn't mean you necessarily want to sell everything and panic at times of distress. But we are kind of on the edge of a bear market. A bear market is defined as a 20% drop top to bottom. And on an intraday basis, we did hit close to 19%. Now, we're not really going to make any artificial distinction, 18, 19, 20%. We're always looking at the fundamentals. And as I'll mention and have a couple of slides to show to this, yes, there are some indicators going in the wrong direction. GDP, we think unemployment's likely to pick up. But there's also some positive things that are brewing beneath the surface. One of the reasons why the market's up today is that there's rumors that Congress is going to initiate a payroll tax cut. That would flow right to somebody's paycheck. And as you know, most Americans spend their paycheck and then some. Another thing that Brian alluded to, the drop in oil prices, yes, if you're working in the energy ecosystem, this traditional energy, that's a big negative. But most of us are consumers. When we drive our cars, heat our homes, that drop in energy prices actually adds to our bottom line. As Susan alluded to, and I'll have a couple of slides on this, the Fed is likely to cut interest rates. The 10-year Treasury is at an all-time low, and that will enable many people to refinance mortgages, student loans, thereby putting extra money in your pocket. So you have to consider the countervailing effects. Even despite the drop in the stock market, there are some firms that are doing quite well. I mean, I wish I owned stock in Purell, which is a private company, but Costco is doing quite well, Clorox, Kroger, I mentioned Dollar General. So there's always opportunities amidst the declines. This is a picture of what Susan alluded to. The Fed is meeting next week. They meet on Tuesday and Wednesday. They announce a decision on Wednesday. And according to futures pricing, there is a 100% probability that they're going to cut rates. As Susan alluded to, the most likely scenario is they'll cut rates 0.75%, but some people say maybe they'll do 0.5% to give themselves a little firepower. Why they're doing this, I think one reason is that they know having an inverted yield curve, which we currently have, an inverted yield curve is when short-term rates are higher than long-term rates. That tends to be a problem for banks because banks tend to pay interest on your short-term deposits and make longer-term loans. So when the curve is inverted, their profitability is diminished. So we think this is a positive for equities long run. It's a positive for refinancing. We know that it does represent a challenge for somebody living on a fixed income that doesn't want to take a lot of risk. This is just a picture of the graph that Susan alluded to. Some of you may remember the 1980s when the 10-year Treasury peaked at over 14, 15%. And the decline has been pretty steady over the past 30 plus years, but the immediate decline, if we zoomed in on the far right on slide 6, the drop from, let's call it 1.5% earlier this year to less than 0.5% yesterday, really startled most market participants. Now, anything can happen, but I do think it's unlikely we get negative interest rates in the US like we've had in Europe. Part of the reason is that, number one, it's not clear that that would spur economic growth, and the Fed has come out in speeches against having negative interest rates. The next line of reasoning is probably fiscal stimulus. And Susan and I, it's our job to follow what some of the Fed economists talk about. And some have even talked about potentially buying equities, which they do in other countries. Right now, it's against the Fed's charter, but that could be something down the road if things got a lot worse. This, I think, is a nice chart, just putting some, I won't say sanity back in the market. This is just a metric of valuation. Right? There's a lot of ways to measure if something is cheap or expensive. The one way that most people follow that's in the Wall Street Journal is PE, price to earnings ratio. Looking at a simple example, the company's valued at $1 billion and has $100 million in annual profits. Its PE would be $1 billion over 100 million or 10. Now, going back over the past 25 years, as you can see in the chart, the PE is averaged around 16.5. Given the plunge in the market yesterday, that number is now a little bit less, in the neighborhood of 15. So stock prices are not expensive, at least in aggregate, and especially with the exceptionally low level of interest rates, we think in the long run, people are going to say at some point, the fear is going to subside, and I'm not getting paid anything in really across the entire fixed income maturity spectrum, and therefore equities, especially those that pay a safe dividend, might be a place to be. Just winding it up with our final, at least my final slide, is, as I said earlier, I think we are on the edge of a recession. You know, the back of the envelope calculation for recession are 2 quarters of declines in GDP. I would certainly think the next 2 to 3 months we'd see a decline in GDP. But after that, it's not clear once the interest rate cut takes effect and drop in oil prices and things of that nature. And if you're looking at the screen, slide 8, Where we are in the current cycle is the light blue curve at the bottom. The recovery we've had has been long, but it's been very weak. So there's no reason after a short blip that we can't keep going on. So at this point, once again, we encourage you to speak with your specific advisor. We would support incremental changes if you're uncomfortable with the volatility. But at this point, especially with the market down almost 20% from its peak, selling everything, going to cash, and deciding when to get back in at the optimal point, we think that's a decision that nobody can make with 100% accuracy. So with that, we're happy to address some of the questions. I know some have been mailed in, and our colleague Megan is also giving us some questions in real time. Let me hand it back to Brian, who will quarterback the Q&A session.
Thanks, John. Thanks, Susan. I think there's been a couple of questions that have come in that we've addressed through the commentary, mainly around, what are we doing to reduce risk in the portfolios? And, John has alluded to some options. Asset allocation is one of the key things that we look at. And really, that's really been, fixed income's been the balance in the portfolios. And if a client had called today and said they needed to withdraw a certain amount, that would be the place where we would take it from in the asset allocation. Because again, we do think that we've hit some sort of a panic level in the market. Valuations are relatively inexpensive on the equity side and so forth. So as we set those long-term allocations, that's really how we work in risk management within the portfolios. Sure, there's some things that hold up generally. Gold, John alluded to, real estate, things of that nature in portfolios. But, again, given the rapid changing in the environment, wholesale changes, again, across the board at the firm, we're not recommending. Again, examine the allocations, examine the cash levels. If we need to raise some cash for individual situations, we're more than happy to do that. It'll be the question of what we do and when we do it. Speaking about the equity strategies, there's a question about, looking at the companies that we own. Are we selling companies that have high debt levels and low profitability that may be at risk of going out of business? That's the key mantra, even in good times. We want to own companies that have very solid balance sheets and high quality and have increasing levels of profitability. That's where you get your return. So that's a constant effort. That doesn't start when things go a little bit awry as they are now. In terms of rebalancing portfolios, we don't let the calendar dictate. So we're not on a monthly or quarterly rebalancing schedule. It's really a sentiment type lead driven, or are we out of a client's risk lane? With last year's high return on the equity sector in portfolios, have they gotten out of balance? I know a lot of our portfolio managers have raised their RMD requirements for clients earlier in the year. So again, it's not a mechanical answer to the question. It's really, are we out of the risk lane in client portfolios? And for the most part, we're monitoring that all throughout the year. We're monitoring that in great times. We're monitoring that in really poor times. And I can confidently say that we're not at those levels yet where lots of clients have migrated out of their asset allocation tolerance. And then the final question really has come up in a number of times, and I've seen this. We've gotten certainly responses from some of our vendors about their contingency plan. What if the virus were to spread and we couldn't get into our locations here in Morristown or in New York City or out on Long Island? And at the end of yesterday's note, I had said that Beacon employees have remote access. We haven't determined, it hasn't affected our building or our location yet, but please know that we do have remote access. If we were forced to not enter our building here in Morristown or in New York City or in Long Island, Beacon Trust still is open. You have access to your team, regardless of where we're working from. I think that's important. We've tested it. We had a really positive test last week with our remote capabilities. So we're very confident that, we'd be able to be in contact with clients either via email, phone, text message, things of that nature. So we're going to try to keep everybody informed of this rapidly changing environment, but please be assured, again, our priority is to service the clients, and regardless of where we are, we're going to be able to accomplish that goal. With that, I don't think that we've gotten any questions that we haven't addressed. One's coming in right now.
Okay, so one question is that the PE ratio has come down. Do you think that earnings are going to come down as well? I certainly think that's likely. Clearly, some sectors have been decimated. Airlines and travel is one, or two areas, energy as well. That, once again, is offset by the drop in interest rates. So the way to think about it, the way we think about it, is the lower interest rates and taxes, and I just talked about a potential payroll cut, the higher the PE you can potentially afford. So I would just describe it as the market is not extremely expensive. Each of our managers see value in the market. Most of our equity strategies, their mandate is to be fully invested. So how you would reduce portfolio risk is at the asset allocation level. Now we realize everyone at Beacon has a different portfolio. Some clients have 100% fixed income, some clients have 100% equity. But with our typical balanced portfolio, as Susan alluded to, fixed income, investment grade fixed income is doing quite well. So our average balanced portfolio, I would say, is down single digits, and in many cases, mid-single digits or less, which I think is in the risk tolerance of most clients. So things are evolving quickly. As I said, our baseline case is that things will be weak for the next, let's say, 3 months, but we wouldn't necessarily recommend wholesale changes on that outlook. If we felt that we were imminently in a recession that's going to last 1+ year, that would result in a more meaningful asset allocation change.
One more coming in. Generally, bonds and stocks move in different directions. I'm observing stocks and bonds both down. Will that continue?
Well, let me start with that, and Susan, feel free to jump in. Generally, investment-grade bonds, treasuries, for example, have been moving in the opposite direction of equities. The bonds that have been getting hit are those that are generally not investment grade, certainly high yield, certainly anything tied to the energy sector. So I'd say certainly the bonds that Susan picks for our clients have been performing well. The issue we're kind of facing now is that with interest rates so close to zero, there's only so much more help that bonds can provide. And this may result in us looking at something besides bonds to provide further diversification once interest rates approach that zero bound. Susan, I'm not sure if you wanted to add anything on the risk reduction capabilities of fixed income.
Yeah, no, I would agree with you what you said. High quality is performing very, very well and rallying quite a bit, especially through these past, 6-7 days. But what John said about the lower quality junk rated names that are very tied to the stock market are moving in tandem with the stock market. Even on the municipal side, if you look at some municipal bonds that are travel related, bonds that are maybe backed by revenue from a terminal at an airport or directly by an airline, those bonds have been hit very hard as their, travel and leisure sector has gone down also. So I think you can't say one's going down, one's going up. You have to look at the individual security that you're looking at on the bond side and see how that's either correlating or not correlating to what the stock market's doing.
Thank you, Susan. We have a question from the audience on two of Beacon's mutual funds, planned return strategy and accelerated return strategy. So they are asked to comment on the performance. Well, the good news is that those that are in planned return strategy the fund has been performing roughly as expected. Just to get everyone on the same page, in case you're not familiar with the strategy, Plan Return, what it tries to do is give away some of the potential upside and uses some of that potential upside to buy some downside protection. So rough rule of thumb, historically, the strategy gives about 2/3 of the market upside and protects half the market downside. On a year-to-date basis, I think it has been following that. So hopefully clients in the Plan Return strategy are pleased with its risk reduction capabilities. That being said, it is tied to the S&P, so when the market goes down, it should go down, just not at the same rate. Accelerated return does not have that hedge, so it tends, tends to have similar to market performance. There can be some modest windows, let's say when the market is up single digits, where accelerated return may outperform the S&P. So I'd say overall they're performing in line with expected, but I wouldn't expect much risk reduction capabilities from the accelerated return strategy.
Hasn't the nature of diversification created the need for rebalancing with the drop in equities and increase in fixed income? I would say that it could create, if we were on autopilot, those scenarios could create where we had very tight ranges for portfolios to migrate. We don't, so there's no automatic need for rebalancing. And as I said, I think that, we let the market play out the way it has. And I'll point to last week, for example, which to me gave us, good reassurance that kind of doing nothing sometimes is the right call. If you remember last week, we had Monday down 3%, Tuesday up 4%, Wednesday down 3%, Thursday up 3%, and then Friday down. If we were in tight ranges rebalancing, you'd create lots of trades that were quite meaningless in client portfolios. So we haven't reached, even with the market drawdown from top to bottom, we haven't reached a point where an automatic rebalancing or anything that would create clients to be out of tolerance with the ranges would create a big rebalancing. Again, we're opportunistic on the economy as we get through this phase of slowdown. The data has not reflected yet any of the March or as we go into April, any of the sentiment involved in any of the economic data. We're still looking at February data, which has been quite good. So I'll lean on that a little bit. The economy was in pretty good shape prior to the panic around the coronavirus and then the energy crisis. Unemployment was historic, the 50-year historic lows. The economy was continuing to grow. We had no inflation. We had interest rates very accommodative. So we have a pretty good foundation going in terms of the economy. That will take a little bit of a hit here as we get data released in April for the March time period and probably May for the April time period. So, the automatic rebalancing, I think, does not lend well in environments like this.
Just to add to that, diversification is kind of our first line of defense with risk reduction. Fixed income has done exactly what it's supposed to do, but it is approaching its lower bound. Year to date, fixed income has gone up sharply as interest rates have fallen. When interest rates approach zero, there's only so much more it can do. It may not lose money, but it's not going to make you any money. So therefore, once again, we are open to a discussion with looking at some alternative assets, whether that's gold or real estate or infrastructure. They may play a complementary role in the event of continued drop in interest rates.
Okay, at this point, there's no more questions coming in, and we've probably exceeded the time limit that we had allotted for clients taking time out of their day to listen. So again, we greatly appreciate your time. We thought it was important to put some voices behind some of the writings that we've done and hopefully allay some fears about what's been happening in financial markets. And again, we always encourage the open dialogue between clients and advisors here at Beacon to make sure we continue to do things right within your portfolio and to ultimately achieve the goals that were set forth within the portfolio. So again, appreciate the time. Thank you very much. Thank you to John and thank you for Susan for also taking the time, and enjoy the rest of the day.